Welcome to the Deep Dive. We're all about cutting through the noise, getting you those essential nuggets of knowledge really fast so you can be truly well informed. Today, we're tackling Vista Energy, specifically their performance in the second quarter of 2025. We've got their official earnings release, plus insights from names you probably know like Guru Focus, Tip Ranks, and Refinitiv. Our mission for you is pretty simple. Figure out what really drove their results, understand maybe some hidden implications, and just get a clear picture of where they're heading. Should be interesting. We might even find a few surprises, maybe a little humor along the way. Okay, so let's dive in. Just looking at the headline numbers for Vista Energy's Q2, they look, well, pretty striking. What jumps out immediately from the release?
Yeah, striking is a good word. I mean, the growth is just huge. We're talking about a massive surge in production. Total production for Q2 hit, get this, 118,018 barrels of oil equivalent per day. BOED. That's an 81% increase compared to the same quarter last year, Q2 2024, and up 46% just from Q1 this year.
Wow, 81% year over year. That's enormous.
Exactly. And oil production specifically, that was 102,197 barrels per day, BBALed. That's up 79% year over year. And this obviously flowed right through to the financials. Total revenues climbed to $610.5 million, up 54% from last year. Maybe the most eye-catching number, though, net income. $235.3 million. That's a 184% jump just from Q1, 68% up year over year.
Okay.
And Guru Focus, they pointed out that the GAAP EPS, that's the standard accounting earnings per share, was $2.26, which beat analyst estimates by like $0.87.
Pretty significant beat.
Right, so massive growth across the board. What was behind it? Just drilling like crazy.
Well, that's the really interesting part. It wasn't just organic growth, the main engine here. It was a big strategic move. These Q2 results consolidate their acquisition of Petronas E&P Argentina. That deal gave Vista a 50% stake in the La Amarga Chica block, and it became effective April 1st, right at the start of Q2.
Oh, okay.
And that acquisition alone added nearly 39,000 polished BOED to their Q2 production numbers. So a huge chunk of that increase. Wow, so this wasn't just, steady improvement. This was a deliberate big step change. What does getting half of La Amarga Chica really mean for them? Bigger picture, I mean.
Oh, it's definitely more than just a quarterly boost. It's a major strategic play. La Amarga Chica is right in the Vaca Muerta shale formation. Very high potential. So securing a 50% interest really signals Vista's long-term commitment to unconventional resources there. It's a big bet on that specific asset.
Okay.
Going to sort of reshape their standing in the region, not just make them bigger. It's doubling down, essentially.
Okay, got it. Now, here's where it gets really interesting for me. You've got these fantastic production, great revenue numbers, but the sources also talk about falling commodity prices. So how on earth did they manage to boost revenue so much when the price they were getting for their oil and gas was actually lower? That seems counterintuitive.
Yeah, it definitely does seem that way. And the price headwinds were real, no question. Their average realized price for crude oil in Q2 was $62.20 a barrel. That's down 13% from Q2 last year. And it was 9% lower than just Q1 of this year. Mostly because Brent crude, the benchmark, was down about 21% year over year on average.
Right.
And natural gas prices were hit too. Realized price was $2.80 per MMBtu. That's down 27% year over year. Lower domestic prices, lower export prices.
Okay, so prices down significantly.
Exactly. But the key, as we touched on, was the volume. That huge surge in production, mostly from the PPASA deal, but also their existing operations, was just so massive. It completely swamped the effect of the lower prices. Think of it like selling way more units, even if each unit fetches a bit less. The total revenue still goes way up.
Makes sense. Volume overcame price.
And another thing they did to maximize revenue, they sold 100% of their oil at export parity prices. So they weren't taking domestic market discounts. They were getting the full international market value. Oil and gas exports actually brought in $345 million. That was 58% of their total net revenue. So leaning heavily on exports.
That's smart. Okay, leaning into volume, maximizing export prices. But what about the other side of the coin? Costs. Rapid growth, big acquisitions. Often that means spending goes through the roof. Did they manage that?
That's a crucial question, absolutely. And they actually did quite well on the cost front, which speaks to their operational efficiency. Their lifting cost, that's basically the cost to get the oil and gas out of the ground, was $4.70 per BOE in Q2. Sequentially flat, meaning it didn't increase from Q1.
Okay, holding the line there.
Right, which is pretty good during a major integration and ramp up. But even more impressive, I think, were their selling expenses. On a per-unit basis, selling expenses actually declined sequentially by 41%, came in at just $3.80 per bow.
Wow, a decline, huh?
One key reason, trucking. They managed to reduce trucking volumes to zero. This was because the Olduvall duplicator pipeline came online near the end of Q1.
Infrastructure paying off.
Exactly. Eliminating that trucking saved them, let me check, $27.7 million in Q2 compared to Q1, just from that one change.
That's significant. A really clear example of infrastructure investment directly cutting operating costs.
Absolutely. It's the kind of detail that shows smart operational management alongside the big strategic moves.
Okay, so strong production, strong revenue despite price headwinds, and good cost control. What does all this mean for the actual bottom line, their financial health overall? Net income looked great, but you mentioned the acquisition. Any catches?
Right, let's pivot to the full financial picture. Profitability first. Adjusted EBITDA was $404.5 million in Q2. That's up 47% just from Q1. And just quickly, adjusted EBITDA, it's a measure of core profit before interest, taxes, depreciation, amortization. Gives you a sense of the underlying operational earnings power. That increase was mainly driven by, the higher production and eliminating those trucking costs. Lower oil prices did offset some of it, but the net effect was strongly positive. Their adjusted EBITDA margin actually improved to 66%, up 4 percentage points from Q1. Pretty healthy margin.
Okay.
Now, net income, while it saw that huge jump sequentially, it was also impacted by higher DDA depreciation, depletion, and amortization, which hit almost $177 million. And they also had higher income tax payments.
Right. Taxes and depreciation eat into that.
Exactly. But here's where we really need to connect the dots, especially for you listening. Capital expenditures, CapEx, and cash flow. CapEx in Q2 was substantial, $356.1 million. About $208 million of that went into drilling and completing their own Vaca Muerta wells. Another $106 million went into developing La Amarga Chica, their share of it. So, heavy investment.
Okay, big spending.
Very big spending. And here's the critical insight. Despite the strong operational numbers, Vista recorded a significant negative free cash flow in Q2 to the tune of $1.356 billion.
Whoa, negative 1.3 billion. That's a lot.
Well, it is. Let's break that down quickly. Cash flow from operating activities was actually slightly negative, minus $9.4 million, mostly because of a big tax payment, $215 million, plus some working capital changes and one-off costs. But the really big number was cash flow used in investing activities. That was $1.347 billion. That reflects the heavy CapEx we just talked about, plus the cash outflow for the PPASA acquisition itself, which was $841.6 million net of cash they got with the deal.
Right, the acquisition costs hitting the cash flow.
Precisely. So how did they fund all this? Financing activities. They brought in $770 million, mostly from new borrowings. They took on almost $1.4 billion in new debt.
Okay.
And the result? Gross debt jumped to nearly $2.6 billion. Net debt, so debt minus cash, rose to $2.44 billion. And their net leverage ratio, basically net debt divided by annualized EBITDA, jumped from 0.84x in Q1 to 1.93x in Q2.
So almost doubling their leverage ratio in one quarter.
Yeah, significant increase, driven almost entirely by that acquisition funding and the heavy investment.
This is really a key takeaway for you, our listener. Booming revenue and production, yes, but fueled by a massive investment and acquisition that led to deeply negative cash flow and a big jump in debt, at least in the short term. It really signals they're in full-on growth mode, right? Prioritizing expansion over immediate cash generation.
That's exactly it. It's a classic reinvestment phase. They're betting heavily that these investments, especially in the La Amarga Chica, will pay off handsomely down the road. The question for anyone watching Vista is whether that long-term story justifies the short-term cash burn and the higher risk profile that comes with more debt. It's a strategic gamble.
Okay, so given these, let's say, mixed signals, great operational growth, but this heavy spending, negative cash flow, rising debt, how is the market reacting? What are analysts or even AI tools saying about Vista's stock?
Well, it's interesting. We see some different takes, partly because of how you measure earnings. Like we said, Guru Focus flagged that GAAP EPS beat estimates handily, $2.26. However, Refinitiv pointed out that Vista's adjusted EPS, which often strips out things like acquisition impacts or other non-recurring items, was only 55 cents per share. And that actually missed the average analyst expectation, which was $1.20 per share.
Okay, so GAAP looks great, adjusted, not so much. That's a really important distinction for you to pick up on how different metrics can paint different pictures.
Exactly. GAAP includes everything. Adjusted tries to show core performance. The GAAP here suggests the acquisition and related costs might be colliding that core operational view into the GAAP number, or perhaps analysts were focused more on the adjusted figure.
So despite that mixed EPS signal, what's the overall analyst sentiment?
Generally still positive, actually. CrewFocus cited 9 analysts with an average one-year price target of around $70.69. That implies quite a bit of potential upside, like 44.5% from the stock price when the report came out, which
Yeah.
was near $49.
Okay, so analysts see significant upside potential.
Yeah, and the consensus rating from 11 brokers, according to Guru Focus, averages out to 1.7. That's basically outperformed or a strong buy territory. Refinitiv data showed something similar. 10 strong buy or buy ratings and only one hold. No sells.
Interesting. What about the AI perspective? Like tip ranks?
TipRank's AI analyst Spark also rated VSD as outperform. It acknowledged the strong financials and the strategic moves, but importantly, it also flagged the challenges, the increased leverage, the negative free cash flow. It mentioned potential stock volatility and noted there's no dividend yield,
So even the AI sees the opportunity, but also the risks.
pretty much. And reflecting maybe some of that caution, the stock itself, while up a bit this quarter, about 2.3%, is actually down 9.6% year to date. So the market might still be digesting this big move in the associated financials.
Right. Okay, what a fascinating deep dive. We've seen Vista Energy achieving, truly remarkable growth in production and revenue, fueled by that huge Pipasa acquisition, getting that key La Marga Chica stake, and they coupled it with smart cost controls, like getting rid of trucking costs via that new pipeline, clearly making bold moves.
Definitely bold. But as we saw, that growth came with a hefty price tag, massive capital spending, deeply negative free cash flow for the quarter, and a significant jump in debt and leverage. It really highlights that classic tension, doesn't it? Aggressive expansion versus immediate financial stability or liquidity. It's a high-wire act.
Yeah, absolutely. So as you're processing all this, here's something to think about. How do these big strategic long-term investments, even when they cause short-term pain like negative cash flow and more debt, really position a company like Vista for the future? Are they building sustainable dominance or taking on too much risk? And maybe also consider how those different ways of looking at earnings, like GAAP versus adjusted EPS, can give you such different, sometimes even contradictory signals about a company's health. It really pushes you, doesn't it, to look beyond just the headlines and understand the full story, the nuances behind the numbers.